Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor or you want to be a multifamily investor, maybe you've been in the industry for decades, this is the YouTube show and podcast designed for you to keep you absolutely the most up to date with all the best information surrounding the multifamily industry, real estate, and the economy. Some great reports on the show today. Reports from RealPage, Marcus and Millichap, Berkadia, Cushman and Wakefield. So we got some interesting data on where interest rates, cap rates, and prices might be at the end of 2022. Also, a lot of interesting sentiment surveys, a lot of data that's going to help you just keep you in the know. And again, in this highly volatile, high frequency market that we're in, you got to stay on top of it because this week is different from last week, different from the week before. And that's why we're coming to you every week to keep you up to speed. Joined by Matt Bosnagel, Director of Communications here at Gray Capital. Let's get into it. Welcome back to the report, Matt Bosnagel. So happy you're back on the show. You were here last week, but you've been out on assignment out in Seattle. How was the trip? What information were you able to gather?
They say Seattle's rainy all the time. Not a whole lot of rain.
That's good.
They also, one thing I noticed a lot there that I didn't really read about before, it is riddled with blackberries.
Oh yeah.
So I was staying at my brother-in-law's place, and it was like, oh yeah, it's like a weed here all along the highways and everything.
Yeah.
But I did, it was very fun.
And they get the late summer blackberries. There as well.
I didn't try eating them because I was like, no, I'm not going to eat a questionable blackberry.
No. I mean,
maybe one in nature, but one along the highway.
Yeah.
I'm not going to try.
Yeah. I don't recommend the highway berries.
Yeah.
Going off in the woods maybe. I mean, we get a lot of blackberries here in Indiana, but not necessarily in the late summer. It's more of like a early July
it is
thing.
interesting. All the different climates. It was perfectly mild. We went hiking at the base of Rainier and stuff, and it was really
Washington
really cool.
State. I think it has like some of the diversity of ecosystems.
Mm-hmm.
I mean, California similarly, but like Washington State has so many different ecosystems. They've got rainforest in Washington. I'm pretty sure they've got desert. They've got mountains. I mean, they've got all kinds of interesting climates.
This is a story. So I was pointing at Mount Rainier. I was like, look at that. And then all of a sudden, a bird landed right on my finger, perched right there. And you said ecosystem. It's because there is a ecosystem of birds and animals feeding off of hikers.
Fingers? Off of hikers.
Not fingers, but hikers. Yeah.
Wow.
Because immediately, they were very friendly. I saw a very fat chipmunk very close to people. I was like, okay, these animals within, if you're close to the trail, you're getting some handouts.
So it landed on your finger?
Yeah, it landed right on my finger.
You got any evidence? You got any?
No, I don't. I don't have any evidence. I just have a story.
Witnesses.
Can be corroborated.
Yeah, that very cool.
It was very fun.
Well, okay, let's hop right into the report, Matt, because we've got some really good articles and a lot of good stuff to talk about. First, RealPage, Jay Parsons put out an interesting report that I think contradicted some of the kind of the anecdotes and some of the things that we were thinking about on previous shows. So that's why we wanted to talk about it. And I don't think it necessarily says that we were wrong, but I think it gives us a little bit more insight and I think maybe a better way to kind of look at it.
I was definitely persuaded. We've read and we've even said a lot about how high mortgage rates are maybe going to boost the apartment market because they'll discourage renters. But there was never really any hard data behind it. So I really appreciated seeing this information from Jay and put a really good, realistic, and pragmatic perspective on it. And likewise, I remember a couple of years ago when home prices really started to surge, we were saying that high demand for single-family homes does not mean that there's low demand for apartments, and we saw that really come to pass. Demand for houses increased just as demand for apartments did. So there's this connection between housing in general among the different kinds of housing. When it goes up, and everywhere it does. Yeah. And so to think that there's going to be a dramatic change from this from higher mortgage rates that will sustain apartment demand is maybe a little bit of wishful thinking. It is a it is an interesting story, and I still think it has some legs, but maybe not as much.
I think Jay's point is that it's much more on the margins. It's not really a main driver, and there's a lot more important drivers to focus on. And with household formation being kind of that key driver of, if there's declining household formation, people aren't moving out, roommates aren't kind of decoupling and moving out into separate houses or apartments. People are, if anything, moving in together with negative household formation, and that's a much bigger driver to pay attention to. That moves again the for sale single family home market as well as the apartment market itself. And again, it's the same thing in the pandemic. I mean, with the stories of everyone's buying homes, that didn't people weren't leasing apartments. In fact, demand for apartments was skyrocketing as well. The other big piece that he gets at, and I think that it can't be underlined enough, is that sentiment. The consumer sentiment and how people are feeling about the economy, how they're feeling about their own personal financial situation in the future. Not necessarily about like how their financial situation is today. They may be making a good income, they've got a job, all is good, but they're concerned about the future. It's going to make them think twice before making a large decision, like signing a lease or buying a home.
We've talked a little bit about low home buying sentiment, and it's hard for me to wrap my head around, because I think that really what is easy for me to track is like what the actual actions are. But I think that right now, sentiment about the economy moving home buying decisions is maybe a little bit easier for me to understand than sentiment about home buying itself. And I also wanted to, like a similar story that we tracked last year or the year before, really, was this narrative. So now there's this narrative of mortgage rates. They're going to reduce home buying and people stay renters. A couple of years ago, there was that story of people moving into smaller metros with a lower cost of living because of remote working. That didn't really come to pass, but it did come to pass a little bit. And I wonder if this is going to be the same story. So people maybe didn't wholesale move out of big cities into small cities, but places like New York and San Francisco, they really did move out somewhat.
It did happen. I mean, Boise or markets like Asheville or Chattanooga, markets like that. I mean, they did relatively well over a long-term basis. I know there's some turbulence now with some mean reversion. But I think overall on a bigger picture, less of a major driver than some of the bigger household formation and
what interests me about that trend, as well as this trend in mortgage rates, it's the same thing as this. Maybe it's not a huge dramatic trend that's really noticeable, but even if it's just a marginal mild trend over the long term, that consistency I think is incredibly interesting.
I think so.
Mostly because, first of all, I'm skeptical of rapid trends in the housing market in general, because last time was a pandemic or
it's so much flash and
but I'm also interested in the long-term potential of this trend with mortgage rates, because even if it changes just a small sliver on the edges for lifelong renters, even if it changes just as a little bit of people into lifelong renters, that's a big deal. We're talking about going against the grain of like a centuries-old conception of home ownership and American identity, and changing people's minds on that even a little bit is going to be extremely significant.
Well, it's the millennials and Gen Zs that are going to be making that decision. I mean, that's the bulk of the renters, as we're going to see in one of these surveys later on. But just to test it, I want to pull up a chart, Matt, because looking at comparing household formation and interest rates, and specifically mortgage rates. Is there anything? What is the correlation? And so let's look at a chart of household estimates. So this is essentially how many households going up and down is. Going up is increase of household formation, and the inverse would be decline. And then also looking at the average 30-year fixed rate mortgage. And what we found interesting is we saw this big jump in household formation. Kind of basically, almost immediately at the start of the pandemic and the recession back in 2020, and at the same time, interest rates were steadily declining. But they didn't really bottom out until, really, kind of January 2021. And then as soon as the discussion of interest rates rising started, they didn't rise yet. And they ticked up, mortgage rates ticked up just slightly, but, it was a sharp peak.
And they were no longer going down.
But they were at the same rates they were just a couple months ago. But then look at how, I'm speculating that this is 100% driven by, or mostly driven by, sentiment rather than the actual price. It's people assuming and being concerned that their mortgage rate was going to be higher, so people just left the market, and we saw household formation or households start to dip dramatically. I mean, it's almost like a sine wave, the fear of the incredible demand at the beginning, and then change in interest rates right here in basically February and March, and then just a huge trough, and then it's popped back up as interest rates were declining, and then they've increased once again, and it's sort of leveled off. But this is much more about sentiment rather than actual, I can't afford something. Although there are people, 100%, it's not an anecdote because we've seen the data to support this. Yeah. I know we looked at last week. There are a lot of Americans who could have afforded a home. Mm-hmm. Maybe they they didn't want to buy one. Maybe they did. There's a lot less of those that can afford a home now. And there is a lot of evidence to support that. But to Jay Parsons' point, household formation, positive or negative, and that sentiment is still a much stronger factor. And it doesn't matter if people can't afford a home. Yeah. They may be moving in with a roommate or moving in with their parents. You're going to see a decline in household formation. It's a much more a stronger demand driver than cannibalizing from the single-family home market.
Yeah. And another thing about household formation is it does seem to, one of the predictive abilities, if you're going to try to predict, is what was happening a year ago or so. Because you see that huge spike in household formation immediately following the pandemic. Yeah. And then it was followed by a dip just as dramatic. So it kind of evens out, and we're getting around 1.5 at the end. But I think that it's hard. It's just incredibly hard to predict. There's a lot of factors. I tried to read a scholarly article on it last night, and it said that the labor market and economic situation plays a big part in household formation. But even then, just looking at the chart and how much volatility there is, it's incredibly hard to predict anything on, especially like a month-to-month basis. And sometimes it swings wildly from month to month. So it's incredibly hard to predict.
It really is. Well, just to kind of put a bookend on this report. So I mean, there's some, I guess, not some negative connotations of hey, we've got some concerns with household formation, but he also does say kind of at the end of this that the fundamentals for multifamily and renter demand are still very, very strong and more tailwinds rather than headwinds. He says that their view of consumer sentiment will eventually tick back up sooner rather than later. And then some more tailwinds. The unemployment rate is incredibly low. Job growth continues to exceed expectations. Incomes continue to climb as well. And then the demographics. This is the long-term trend. Some of the long-term trends you were mentioning, Matt, is that there's not going to be a big valley in terms of going from millennial renters to Gen Z renters. He mentioned that going from baby boomers to Gen Xers, a lot less Gen Xers than baby boomers. Yeah. And then that occurred in the 90s when Gen Xers were renters. Just not enough people to fill up those apartments. There wasn't that driver of those people in that age demographic that are renting. Yeah. But even though millennials are a bigger demographic group than Gen Z, the Gen Z generation, it's not such a dramatic difference that there's going to be a huge drop off. And then more millennials are renting for longer because of all we've talked about. Yeah. And so, again, the demographics are pointing us in the right direction.
One more thing, and you kind of skimmed over it. He predicts, and he said at the end when he was talking about the demographics being good and everything like that, at the end of that sentence, he said demand could be somewhere between, it's a couple paragraphs up, almost hidden, and it's almost tossed up. It's one paragraph above there, and it says, rental demand in 2023 could be somewhere between 2021 and 2022 levels. That's great. That's kind of incredible. Because if you ask me, I'd think that it'd be a little bit below current levels.
Yeah, I would say it'd be between 2019 and 2020. And 2020.
Maybe that's a typo. But if that's the case, that means that the performance of 2023 will be better than 2022.
I think that's an interesting interpretation of how he's interpreting it, because that's the first I've heard that flies a little bit in the face of kind of the moderation. And I mean, if I had to again do very lazy math, I think the demand that we've seen in 22 is basically half what we saw in 21, I think we see half the demand again. Next year.
I think that's
it's like we had
trend for sure.
Like 16% growth in 21. We're going to get 8% this year, 4% next year. Still higher than average, but very much moderating and normalizing. That's like like lazy, and it's just like demand's going to have to normal that, or we get a decline. But I don't. Again, with all these tailwinds, I don't see a major decline. Just given where we are in the economy and in the market.
Completely agree.
Matt, let's move over to housing before we jump back into multifamily. Marcus and Millichap put out this nice report. Home listings notched 20-month high, yet remain just half of the long-term average. So again, this is where it's all relative, and we're dealing with all of these base effects, and we're dealing with our short-term memories, and you can pick out statistics to make basically whatever argument like, especially in this market. Because we've seen a lot of reports of single-family home price growth decline, which is different from price declines, and then you will see a report that listings are at a huge high year over year. But then looking at the long-term average, it's still pretty very, 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 very low.
Rates are still high and climbing. That's one thing that may be cooling the market. Sellers are reducing their prices, but there's still really a ways to go before the housing market gets more affordable. And they said with homeowners reluctant to sell homes and get a new one with higher rates, people are sticking around in their homes and mobility is down. And they're also speculating that maybe like retail areas like furniture and other like upgrades that you can buy to upgrade your home will be where that money is spent. Maybe they'll spend some money on self-storage if they can't, if they're looking to buy it, expand, then maybe they'll go into self-storage. Basically, though, what another thing they say is that the newly built home market is becoming a little bit oversaturated. In July, the volume of single-family homes under construction listed on the market climbed over 30% year over year. Meanwhile, the number of these types of houses that sold fell 40% from the prior year. As a result, the month's supply of homes under construction at the current sales rate eclipsed 18 months, a threshold not reached since 2009, which was a notable period of housing instability. It's a little bit weird that newly built homes are not doing as well, but that might be a product of these are the ones that are on the highest prices.
And I think the prices are high, but there's also more of them. They'll use a local example that people outside Indianapolis won't maybe not follow, but everyone wants to live in or not everyone. A lot of people want to live in kind of Meridian Kessler, Butler, Tarkington, Sobro, Broad Ripple, but you're not building new homes. Very few. Every once in a while there's like a lot available, but it's the existing inventory that's there. And those people, we've all locked in their mortgages, but most likely in the past couple of years have low rates. Why would they sell and move right now? But then out in the suburbs, you got tracts of land, you got cornfields that you can tear down and build a whole subdivision, and developers have been doing that. So there's a lot more of them. And so the newly built homes, you'd expect some kind of decline because a lot of developers are building on speculation. They got a bunch of newly built homes that they got to offload. So I think it makes sense just because that's where the new supply is. And again, I think there's still demand in that existing home. There's probably more demand for new homes. There's just a lot more of them. And so it's just, I think, that balance of supply and demand.
And that's one of the things that I noticed in gathering the reports here too is, yes, they're building new homes, but things are getting slow. And that we've talked about that weeks really is how much
they're building
longer.
Them, or they're pulling permits, but are they completing them?
Exactly.
I mean, they're working on
it. They're not completing them, not in time.
I haven't been able to complete the patio on my deck for like a year. So
that's right.
Anyway, Berkadia mid-year powerhouse poll 2022. A lot of interesting questions. Again, this is just being polled by CRE experts, industry insiders, a lot of the brokers over and market leaders over at Berkadia. So there's a handful of questions here that I think are interesting to look at. Some maybe not. Again, because not anyone has a crystal ball, but understanding sentiment, as we can see, Matt, sentiment can drive markets more than anything.
I thought that it was particular. There's some validity because all of this is really in-house. So the sample of 51 Berkadia sales advisors, basically, I think brokers, and 72 mortgage bankers. I think I don't know if it makes it accurate, but it definitely means it was probably pretty consistent. And the survey itself covers apartment demand expectations, supply, technology advancements in the multifamily industry, and trends related to institutional investors. investors, as well as some juicy cap rate predictions as well.
Yeah, and we're going to get to those here at the end. Cap rate, interest rate, and property price predictions. So just hang on in your seat there for that.
Yeah, to break down some of these expectations about rental demand, property supply, and related things. 81% expect demand to continue to outpace supply, and when it comes to new supply in the market, 43% have seen a moderate increase, 24% a sharp increase, and 17% have seen no change. So all in all, we're getting more supply out there.
More deal, and we're seeing that anecdotally. We're seeing a lot more deals come to market for sure.
And so like the fact that 81% expect demand to outpace supply, that's crazy. But I think that is very consistent with what kind of what our expectations are. And also when they're talking about interest rates, 44% of respondents saw a very high impact of interest rates and inflation on their market.
No surprise there.
Yeah, exactly. 36 saw a high impact, 20 a moderate impact. No respondents found no impact on it, which is fine.
Yeah, that's funny. Okay, so I think this was interesting. Investor interest. What are investors interested in? And without a doubt, it's Class A. Class A followed by Class B, and then you're getting the true affordable kind of subsidized, light tax credit housing, followed by single family build to rent, and then C class true workforce housing is not too many. It's not a whole lot of interest, although more than senior living or student housing not being kind of the first choice of anyone.
I thought that was interesting. I know that senior housing is a little bit of a different animal with more details to address, really, than a typical multifamily property. But demographically, I think it looks like a promising area of investment.
Agreed. Yeah,
but
agreed.
Like, there's
Silver
probably
tsunami.
Yeah, exactly.
But then the aging at home.
Yeah, that's
true.
But
at some point, you can only do that for a while. Sometimes it works out. You have to have the resources to do that.
I was also surprised at, how Class C was below single-family rentals and true affordable housing in terms of investor interest. But, a lot of these that are seemingly alternative investments are becoming categories in and of themselves.
I think the build-to-rent concept, it's not brand new, it's relatively new, and there's so much hype about it. I think there's just so much interest in it, and we've talked about just the growth hasn't been there in the workforce housing, kind of C-class space. Inflationary pressures are really hurting those renters the most. They're at a ceiling, and there's the growth just isn't there, and so that doesn't surprise me that that's kind of near the bottom of the list. And I think there's just a lot less interest in kind of student and senior housing, but I think that could be an opportunity for the right investors with the right operational know-how for sure. There's some regional trends. Do you want to? I was going to skip it, but
just quickly the regional trends. The Midwest is doing great, fairly stable when it comes to
I figured that all the
investment.
brokers in their own regions are going to be saying.
But what was it really interesting is on the next page, it talked about how the Midwest did record more impact from interest rates and inflation than other regions, which is, I think that some of these, when we were talking about before how, in remote work, it wasn't like every place all around the country was affected. There were certain locations where certain maybe regions where these broader economic effects have more of an impact. Maybe that's in the Midwest. I'm not quite sure.
Yeah, I think
it could just
the local Berkadia teams are
getting
their 2 cents.
Yeah.
Which generations are renting though? This is interesting, and this is from the brokers, so it's not like an actual polling of the people who are living there, but it's a little anecdotal. But millennials followed by Gen Z are the generations that are renting. Renters' priorities, location certainly always makes sense. Amenities, sure. Flexibility, I don't know what that means. Low maintenance, yes.
So it's millennials interested in a good location with either a pool or an outdoor space. I think that outdoor space thing is really interesting. It's coming close. Apartments and the single family home experience. So, and I don't think they're talking about a dog park that's like 12 feet by 2 feet, next to the parking garage.
Yeah, probably not. Yeah. One thing that amenities is broad based, and one thing that I've been focusing on a lot is, and just again goes hand in hand with millennials and Gen Z. Making up essentially 94% of who is renting compared to this survey, which isn't the actual number at all. But anyway, who that's your target demo, and it will be going forward.
Yeah,
amenities. To me, what's the number one amenity someone wants at their apartment?
Space.
Fast internet. Screw space. I mean,
Oh,
yes,
really?
I'd say space. Yes,
Interesting.
like that is that's like maybe 2, but I think fast internet.
Okay. That's like a must-have.
They're gonna, I mean, you'll stick around in your small apartment if you have some renters. But again, I'm talking about millennials and Gen Z. Maybe more Gen Z. They want a big space with fast internet. That would be the best. You know, but if you so that's the real winner. I think younger demographics, younger millennials and really Gen Z, like they want like the pool. Like I keep like the rooftop pool or whatever pool, that's the place to be.
It's very visible for sure.
But I also think there's being a shift because older millennials are having kids and there's families, and where, you know, you didn't want to maybe have a playground, like playgrounds are being taken out after past like couple of years. I think you're going to see playgrounds being put back in as more families are living in apartments. I think that's just my 2 cents, not what they're saying, but let's look at, because on their renter's preference of amenities question that we should have just talked about, you know, pool and outdoor space, to your point, Matt, fitness center, other business center, club. They don't even mention it. And internet is, I guess it's not considered an amenity. It's more of a utility. But I kind of see it as an amenity.
Yeah, because now you can make it really nice or not nice for sure. And there are ways to make it happen if you wanted to.
Well, and you can provide it for free, or there's a great income opportunities as well. Being able to do like a bulk internet and like cable package, you know, provide that to residents. But again, I think even if they're paying for it, but it's incredibly fast, like it's already assumed that you're going to be paying for internet one way or the other. But if it's incredibly fast, again, how many people are working from home exclusively? Everybody's working from home a little bit. And then, you know, what are millennials and Gen Zs doing? They're playing video games, they're watching Netflix, etc. You need some good internet speed to be able to do whatever you do on the internet.
I agree with that, you know, and it's not just for playing. You want some reliability. I think that's for me. It's like I want it to be there when I need it, and if it's not there, because there are definitely times when I've rented apartments that I've rented where internet service was spotty, and that's not good.
No, that gets you to leave. You're like, I need a place. You know, it's like basic. It's like basic. It's like not providing water.
Exactly. Yeah.
Okay, but strategic investments by institutional investors. What types of strategies are institutional investors most interested in? Rank the top 3. This is, I would say that they don't list the same types of funds that you'd see in other surveys, but usually you'd see an opportunistic fund being at the top. Opportunistic funds, I think, can be confusing because are we talking about a opportunistic strategy that's typically a ground up development or a little higher riskier strategy with potential for higher return, or we're more open-ended and agnostic and looking for opportunities. But anyway, taking that out, in this survey, core plus funds were the first choice by the majority of institutional investors, followed by value add funds and affordable funds coming in at a pretty far away third, and then green bonds and debt funds coming in pretty much at the end. This isn't very surprising. This corresponds with the previous question on what types of asset classes are the surveyees, interested in. A class was the top, so core plus fund kind of makes a lot of sense in that context. All right, now the big kicker, they kept it at the end. Cap rates, exit cap rates, and treasury yield. So cap rates, obviously, that's the metric that we're using to determine the value of these commercial real estate assets, including multifamily. Exit cap rates, that's the cap rate you're going to use when you make an assumption on the cap rate when you sell a property at the end of your business plan at the holding period. At some point, you're going to sell it. How do you evaluate it? Well, the easiest way that almost all multifamily investors and underwriters use is, well, let's look at what my net operating income is at the end of my hold period, and I'm going to divide that by an estimate of the cap rate at that point, and that'll give me my sales price.
So do you when you do your underwriting, are you typically putting a higher cap rate or a lower cap rate than you bought it?
Always a higher cap rate.
Okay.
Because even if market conditions are suggesting cap rates could go lower, you always want to bake in a little bit of conservative. because we can't predict the future and we don't know. And we want to make sure that if something happens, if a black swan event is out there, if just anything happens, hey, we're not going to lose money. We're still going to make money. Maybe it's not going to be the return that we want it to be, but we're still going to have a pretty decent investment, especially compared to the rest of the investment world. And the way we look at it typically is when we paint scenarios where apartments do very poorly, it's like the whole world nothing is doing well.
Yeah,
like nothing is doing well. So we always expand the cap rate. And they ask a question on how much people are typically expanding the cap rate.
Yeah.
We're definitely in the more conservative camp. And it can change a little bit based on the deal.
When you say conservative, you mean you think that it's going to be higher than others?
So the first question, do you expect cap rates to be higher, lower, or the same? Let's just start there.
Yeah.
The vast majority, 74%, say higher, which means prices will go down. With 26% saying they'll be lower, prices will go up. So it's not, it's a super majority of saying the cap rates will be up. And we've already basically reported that cap rates have come up, a little bit this year. Then exit cap rates. This is what we were just talking about. How are investors underwriting exit cap rates in your region? 48 of respondents said they're using 50 to 75 basis points higher than going in. So if you are buying at a 4% cap rate, that means your exit cap rate would be 4.5 or 4 to 4.75. That's what most people are doing. The second largest cohort is using 25 to 50, so even less. So if you buy at a 4 cap, you're assuming a 4.25 to 4.5% exit cap rate. Only 11% are using 100 basis points or higher than going in. So you're buying at a 4 cap rate, you're assuming a 5 cap rate. We are more in the minority of the 100 basis points.
Okay. Wow.
Typically.
Yeah.
Because we've bought some properties at a kind of mid to low 4s, and we're using typically 5 to 5.25 on the exit cap rate.
Okay.
But it kind of depends on the market and the strategy. If it's like a value add project, you may be buying at a lower cap rate because you see a lot of opportunity to increase rents and add a lot of value. But we want to increase our cap rate, quite a bit. But if we buy it at a 4 cap, we're still probably not going to sell it for a 5 cap.
Yeah.
Or we probably will, but we're like, well, it's a B class asset. It might be reasonable that it sells at a 5.5. So maybe we'll go to 150 basis points on a deal.
Oh, okay.
Or around 100.
Yeah.
Or, maybe that, but at the same time, like if we're buying a property right now, and we're buying at a great cap rate, it's like mid 5s. That's because there's some issues with the seller and there's some things to figure out, that's why there's like a premium on it or there's a discount on it. But do we think that it's going to sell for like a 7 cap? Probably not, because it's like a new asset, Class A. Yeah. Probably not. But because of like the submarket, or because of the general market that it's in a great submarket, average, regular market. That market just gets a slightly higher cap rate. So that makes sense. But we think it's going to still trade within a relative lower range to that market. So we're not expanding that cap rate as much. We're more in the 75 basis points range on that deal.
Whoa, 75 basis points.
Yeah.
That's still conservative. That's what I mean.
Yeah. Well, according to this, it's still, pretty conservative. But then treasury yields, interest rates. Where do you expect the 10-year treasury yield to be at the year end 2022? This is almost useless because nobody knows. But most of folks are saying it's going to be over 3.25%. 33% think that. However, 48%, almost half of respondents, believe it'll be between 3 and 3.25%, 3 to 3.25. That's kind of where we are today. So they're basically saying it's going to stay in the range, it's going to trade in the range, and only about 20% think it's going to be lower than 3. Yeah, it was lower than 3 a couple weeks ago. Yeah. Anything can happen. All right, now moving on to this Cushman and Wakefield blockbuster report, Matt. I thought this was a really good one. And so they've got a couple kind of breakdowns, but they have a full deck. And that's going to be on this week's Gray Report newsletter, I assume. It was on last week's.
It was on last week's, yeah.
It was on last week's. So
put a link to it. Link in the video notes.
Yeah, they'll be in the show notes. But again, that just goes to show you gotta be signed up for the report.
That's right.
GrayCapitalLLC.com/newsletter. You're going to get these reports and so much more delivered to your inbox every Thursday morning at 8:30 Eastern. It's an invaluable tool to investors.
Now, So I wanted to precede their fuller document on where property values are headed because they also had this one. So this is a little pull out of some information. It's called Multifamily Market Insights.
Yeah, it's a little difficult to navigate, but it has really good information.
Puts a little bit of spin, I think, and a little bit of an investor-friendly framing on their report from last week. Basically, they're saying that kind of spreads will have to normalize, and so basically, typically, corporate bonds are seen as less risky than multifamily investments, and corporate bonds usually have a cap rate about 100 basis points lower than multifamily investments. Nowadays, it's almost like a little bit of a reverse, where we have multifamily at 120 basis points lower than corporate bonds. So Cushman and Wakefield say that multifamily cap rates will have to go up to remain attractive. That kind of makes sense, given that those larger trends. Their other pullout was that long-term returns remain healthy. Multifamily has done twice as well as any other sector in the past decade, and there's plenty of return yet to be realized. But, and this is something that we've said doesn't really even need to be said anymore, 2022 is different from 2021. It's the 2022, we specifically said it while it was happening, that it's not sustainable. It was only like hyperventilatingly high. So we are moderating. We're normalizing. Call it what you want. Just don't call it a cool down. And then finally...
You don't trigger Matt.
That's right. And ultimately, though, multifamily is attractive regardless of the scenario that you pick. In their study of property values across all commercial real estate types, which we are going to get into in just a second, multifamily was the only one that performed well under all of the scenarios that they projected, whether it's a mild upside, soft landing, brief recession, or a stagflation environment that we're facing in the next 2 years. All in all, it's very reassuring, an optimistic breakdown of their multifamily projections, but things look a little different when you look at the numbers themselves.
All right, so let's get into some of it. So they've got this broken down into 3 pieces. They've got that summary, they've got this page that has some cool infographics that we can play around with, and then they've got a full deck. Again, check it out in the show notes after you subscribe to the Gray Capital YouTube channel. This is all property types looking at 4 different scenarios. Again, Matt just mentioned a soft landing, upside growth, mild recession, and stagflation. You can imagine that things do the best in upside growth, soft landings in the middle, mild recession, and then the worst being a stagflation. Sorry, Matt, where do you want to go? Where do you want to go first?
No, I just wanted to review really quickly so they did assign probabilities of each of these happening. They have the soft landing with a 30% probability, and the upside growth has a 5% probability. Mild recession is their big one that's going to maybe happen, a 50% probability, and their fourth is that stagflation with another 5% probability. There's 10% missing from that, but that 10% is like other.
I was going to ask about the 10%. So I was looking at his numbers, and I was wondering what the other 10% was. It's just unknown. Okay. So let's just jump to multifamily. And basically, they're showing that, there will be a, slight price decline over the next year as cap rates rise, but then a continued growth after that. And again, in any scenario, it looks relatively positive, except for the stagflation piece, which is a little contradictory from some research that the Berkadia team has done, that Noah Stone did, that's showing that stagflation, that multifamily actually performs pretty well in stagflation. I guess the only caveat to that previous report compared to this is that there's only been so many examples of stagflation, and so it's hard to really go back and to compare those market conditions. And the market conditions we're seeing today are quite different than the past, although I'd say there's a lot of headwinds going into stagflation if that is the case. Although the probability is more for mild recession or mild recession, really, rather than anything. Yeah,
it's stagflation that's the real outlier here. I was a little bit surprised, very almost chastened, in seeing just the fact that these property values are look like they're going down significantly. I think that one thing that is reassuring, aside from their multifamily outlook that they just kind of framed everything, but a little bit reassuring is that these commercial real estate investments are long-term investments. You're not going to be holding them for 2 years. Hopefully, you're not going to be picking them up at a high and selling them at a low. And when there's only 2 years where they're saying that things are going to dip a little bit, then there's a high probability that you're not going to be kind of screwed.
Yeah, that's a really good point, Matt. It's something that we've talked about a lot lot is that if you give duration to your investment, if you're at least holding for 5 years up to 10 years, you can really mitigate a lot of, just market volatility. Just your point on this projection, 2023, we may see some declines, although a lot of these declines, are really, they say that they've happened, during 2021 to 2022, which we have seen some cap rate expansion. But the question I would have for the authors, are we talking about cap rate expansion or valuation movement? So again, valuations versus cap rates, and I think they answered this question that we just posed in the report if we just go into more detail, because obviously we have cap rates, but we also have net operating income. And so they're projecting in a mild recession. This is a mild recession, which is the most probable scenario they're showing, is a slowdown in net operating income growth, but mostly remains positive. That's mostly being driven by continued rent growth, although some expense growth is going to be pulling back from that. And if there's a big pullback in demand, you could see some net operating income numbers moderate slightly. So they don't have anything negative. It's pretty much all positive except for a stagflation environment, which is basically a mostly flat scenario.
Yeah.
Which makes sense. You'd see some price declines if cap rates went up and net operating income remained flat. You'd see some significant declines, but you could have cap rates remain flat or even expand a little bit. But if you have net operating growth, growing at quite a clip, you can see some price growth or valuation growth.
Yeah, it looks like office properties are the ones that suffer the most, and they're the ones that are going down a little bit. But multifamily has seen the sharpest increase and decrease. However, they're all basically positive except for office under this mild recession forecast.
This is a 33-page report. Again, if you're interested in cap rates, net operating growth, price growth, I highly recommend checking this full report out. So let's look at this. So, well, actually, I don't know where we're going. What are we going to do?
So yeah, they explain NOI. They explain cap rates. They kind of put them all together, and that's where they get their information on property values. And this page here specifically on U.S. multifamily is where I kind of settled on when I was reading the report. Now, when it comes to year-over-year percentage change on property value, it's positive. It's negative in 2022 under the soft landing, negative 11%.
Well, so I think that's the biggest takeaway, is that if we're going to see, they're saying the declines have either already occurred or they are going to be occurring over the next couple months. Yeah.
So if it's a soft landing, and now this is actually really interesting I almost think that the numbers themselves paint a little bit more of a specific picture than the graph that they have here.
Yeah.
So under a soft landing, 2022, you get a negative 11%, and then 2023, negative 4.2, and then 2024, you're starting to increase again by 2, and then 25 by 4, and 26 by 4%. So it's a huge dip in 2022, a little bit of a dip in 23, and then you're kind of going up after that. Now, when there is a mild recession, I'm skipping over upside growth. When there's a mild recession, which is what they think is going to happen, there is 2 years of this bad, of like 11 or 12% reduction, and then you start dipping up. So I think that those two areas are assigned a pretty high probability within their models, and that was the ones that I paid attention to. But yeah, stagflation is clearly the worst. It's 12% on in 2022. We're going down by 14%, and this is year over year. So keep going down 12%, then 14%, then 8%, and then in 2025 we're going down 8%, and then it's only in 2026 where things year over year start increasing again.
I think it's important that prices have increased by 20 to 40%, in the past, year, 2 years.
I think that's probably like the most important context. Is what we're seeing right now is a reaction as much to the high prices as much as it is like the current economic environment. And again, like what you said, these are long-term investments, and unless you have bought at the exact, even if maybe you bought at the peak of high prices, you're going to probably have an investment period that is long enough to see some
and I think that's really important to note, because again, if you are an owner who's owned something for, let's say, 4 or 5 years or a little bit longer, now seems like a great time to still sell. In the last year has been a great time to sell. You've gotten your business plan kind of fully executed. You're going to probably have to invest more money into the property if you keep holding it. Why not sell at these high prices? Because you're going to see, you don't want to wait another 5 or 7 years to sell it.
We're going back to sentiment all over again.
It's all psychology. But if you're buying today or you're buying in the last couple of years, you don't really care as much about what the valuations are going to be in the next couple of years outside of maybe a refinance, or if you're really moving for a quick flip. It's more of what's it going to look like in 5, 7, and 10 years. And so again, it's not that you ignore this, but it's not going to really affect your business plan too much. The one opportunity, though, that I definitely see, and we've talked about this, is all of the bridge loans that were used to acquire assets over the last couple of years, especially in the height of the pandemic. Shorter term loans, typically 2 to 3 or maybe 4 years kind of at the max, those are all going to be coming due at the same time where we're seeing these price declines. You're not going to be able to refinance to pull cash out, so they're going to have to sell them. Yeah. Maybe they're going to sell them at at a small premium, a small profit. Some people are just going to have to sell them because that term's coming due and you can't refinance it.
Yeah.
So I think I think that could lead to some price declines. I think it also could lead to some really great buying opportunities if you are well capitalized and you have that long-term investment duration. I think there's going to be some incredible buying opportunities, which we've talked about. I don't think we're not there yet of just like the fire sale. But again, if you have a long-term outlook and business plan, again, multifamily is where you want to be. It's just we got to get through the next couple of years.
And I'm also thinking about specific local markets.
Yeah, so they say this a couple times of just your local. I mean, it's hyper local.
Yeah. So so things in Phoenix, which I said, it spiked really high during the pandemic and remote working. Now it's kind of going down. That the story of each market in terms of property values or cap rates is going to be much different. There probably will be global, at least national trends when it comes to these things. But the more dramatic effects are going to be the local story.
Absolutely. I think that real estate is always local, and I think some of these. I think there's a lot of speculation going on in this report. I think it's really interesting to look at, but I don't. I think that there's so much uncertainty. I think things are moving so quickly. The biggest thing that I would take issue at that is different, that they just didn't have the information probably when they put this report together, is I think we're going to see higher rates of levels of inflation for even a little bit longer than we thought. Yeah. Looking at the energy market, what's going on in Europe right now, in the UK. The UK government is going to be handing out subsidies to households to cover the high costs of fuel to heat during the winter months. And as we were talking about, Matt, typically the high prices can lead to demand destruction because people just don't have the money to pay for that. But if it's being subsidized, those higher prices aren't going to get defeated away by demand destruction because people are paying the prices because they're not paying them, somebody else is.
They don't see the pain,
And so that, energy prices are definitely a driver of inflation. Energy prices are, it's a global market for energy. And I think that will trickle back into higher inflation in the United States as well. And that's going to lead to further rent increases. And as we've seen from the reports we've seen over the last couple months, there's still room to go for rents compared to incomes or mortgage rates, which is hard to believe anecdotally and from reading the headlines, but the numbers don't really lie. There is actually some more to go from historical standards.
Yeah, one of the things that I did appreciate also about this report was the fact that it was willing to, people are reticent, especially if you have a job in the multifamily industry of predicting things. People don't want to read like the bad reports or the reports.
It's true.
But like this is a very realistic take. And I think that the way that they framed it in the for multifamily specifically before, they put a sunny side on it. But like things are going to be a little bit of a bumpy road for the next 2 years, and it's important to make good decisions that don't assume this crazy breakneck growth. I think things are still moderating. I don't think that maybe things are going to be as bad as this report thinks, but this is going in the back of my head and is definitely going to shape my perceptions of the market.
I agree, and part of this almost feels like they're kind of covering themselves, so it's not all fully optimistic.
Yeah.
I think it'll be interesting to compare what happens over the next couple of years to this report, so I'll have to go back and take a look.
Yeah, for sure.
All right. Great report, Matt. Some great articles. Again, make sure you're subscribed to the Great Capital YouTube channel. Go on over on YouTube, search for Great Capital. We'll pop up. Make sure you're subscribed. That way you'll be alerted every time a new video comes out. Leave a comment because we'd like to respond and give you your feedback. We'll even feature some of your comments on the Great Report itself. And, if you share that, you make those comments, you subscribe, what that does, it gets the algorithm going and it gets this into the eyeballs of so many more multifamily investors. And we just feel like a lot of people need to see this and understand this information so we can have a well-informed market out there. And lastly, if you are an accredited investor and you like the long-term prospects for multifamily, hop on over to gray.fund. You're going to learn all about Gray Capital's multifamily investment fund. We're targeting stabilized, mostly core plus, and a little bit of value add, large multifamily assets in the Midwest. We've got a couple deals under LOI we're going to be closing on before the end of the year. It's pretty exciting. If you'd like to learn more, get in touch with us. Love to have a meeting with you. But other than that, hope everyone has a great rest of their week.
That's right.
See you on the next report.